Hi there, and welcome to Class of Business Financial Services Industry Overview with Unambiguous Training Solutions. The financial services industry in South Africa plays a critical role in the country's economy, serving as a key driver of economic growth, investment, and financial stability. Role players include banks, insurance companies, asset management firms, pension funds, and investment entities. Now, South Africa has a very sophisticated financial services sector with a robust regulatory framework, advanced financial infrastructure, and a diverse range of financial products and services. The sector is primarily regulated by the South African Reserve Bank, or the SARB, the Financial Sector Conduct Authority, known as the FSCA, and the PA, Prudential Authority, ensuring financial stability and consumer protection. Major financial institutions, including the Big Four banks, Standard Bank, First National Bank, Absa, and Nedbank, you might as well add Capitec in there, dominate the banking sector, while insurers like Old Mutual, Liberty, and Sanlam lead in the risk and wealth management services. Now, fintech has been a major disruptor to the status quo. There have been major advancements in financial technology, and increased digital adoption has meant that the regulatory requirements and framework have had to adapt and evolve. The shift towards digital banking, think Time Bank, mobile payments, think M-Pesa, and even blockchain-based financial innovations like Bitcoin has reshaped the way financial services are delivered and accessed all over the world. Additionally, South Africa's financial sector continues to focus on financial inclusion, aiming to provide broader access to banking and investment services for previously underserved populations. This is why, for example, you'll find that when Capitec was scaling up, most of their branches were near the taxi ranks, near the train stations, and they were quite affordable and simple to understand. That is part of the process of going towards making banking more accessible to people who did not have this before. But if one were asked to summarize what the financial services sector broadly does, what would be the best answer? Well, the sector provides the necessary infrastructure for people to make day-to-day economic transactions, such as paying for goods and services, saving for their retirement goals or future goals, and to insure themselves against risks such as theft or damage of their property or loss of income due to disability or severe illness. The entire industry hinges on strong regulatory and legal frameworks that ensure oversight on the conduct of the sector itself. It consists a diverse mix of financial institutions which provide various products and services, and they can be grouped into the following main categories. First up, the regulators. So the regulatory authorities such as the FSCA, or Financial Sector Conduct Authority, which was previously known as the FSB, or Financial Services Board, and the PA, for example, the Prudential Authority. It consists of banks, the Johannesburg Stock Exchange, insurance companies, medical aids, asset or fund managers, and financial services providers. But why the strong regulations? Put simply, strong regulations means you put rules in place to stop things from going wrong, and you professionalize the wider financial system and protect the consumers if things do go wrong. Now, here's something that is really important that you barely ever hear about: the South African Solvency Asset Margin, or the SA-SAM. So what does the South African Solvency Asset Margin do? It ensures that insurance companies operating in South Africa maintain adequate capital reserves to meet their obligations, so that when you claim from OUTsurance or Old Mutual or Auto in general, they actually have the funds to pay out your claim. The easiest way to understand SA-SAM is to look at its key features. Number one, a risk-based approach. So instead of a simple fixed capital requirement, SASAM assesses the actual risk faced by an insurer, like the market risk, the credit risk, the operational risk, etc. Then there is the three-pillar structure. Pillar 1 being the quantitative requirements, which sets out the capital requirements based on a minimum capital requirement and a solvency capital requirement. Pillar 2 is governance and risk management. This one speaks for itself. It's about the governance structures that are in place, the policies that are in place, and strong internal risk controls to make sure that the company is able to do what it was intended to do. There's also supervisory reporting and public disclosure. This enhances transparency by requiring insurers to report financial health and risks. For example, if I should see that an insurer I'm intending to insure with is near insolvency, it will not be a good idea for me to insure my very expensive car, or even this little car that I own that is my one true possession in the world, with that company. Another key feature is the capital requirements. So solvency capital requirement, the SCR, is there to ensure that insurers can actually absorb significant losses in extreme scenarios. The minimum capital requirement, that is the absolute minimum capital needed to continue business operations. So at your lowest, you cannot have a sum in your bank account as an insurance company below this minimum. Otherwise, you cannot operate. Then there is stress testing and scenario analysis. This requires insurers to evaluate their financial strength against adverse conditions like crashes in the market or catastrophic claims. So say you have a year where for whatever reason you have an insane amount of claims. Will that tank the business, or will the company be able to continue operating profitably, saving the jobs, servicing the customers, etc.? This is why you have SASAM in place. It definitely seems like a silly question, but why does SASAM matter? Well, it matters because it protects policyholders by ensuring that insurance companies remain solvent. It strengthens the financial stability in the insurance sector, and it also encourages better risk management practices by these insurance companies. There are regulatory bodies and a few acts that are involved in making sure that SAM works. They are the Prudential Authority, the FSCA, the SARB, the Insurance Act, and the Financial Sector Regulation Act as well. The Prudential Act was established under the Financial Sector Regulation Act of 2017, and it oversees insurance companies ensuring that they comply with the capital requirements and risk management standards. It also enforces the Insurance Act of 2017, which governs the solvency of insurance companies as well as the risk management. The FSCA focuses more on how these companies behave and consumer protection in the financial sector. They work alongside the PA to ensure fair treatment of you and I as policyholders. The South African Reserve Bank provides financial stability oversight and supports the PA in regulating systemic risk. The Insurance Act, it aligns South African insurance regulation with international best practice, while the Financial Sector Regulation Act establishes the Twin Peaks regulation model, splitting prudential and conduct regulation. But by now we've been through a list of different bodies and acts. But who are the main role players, and what holds everything together? To understand how this is all held together, we have to go back just a little bit. See, in 2017, South Africa saw a reshuffle of its legislation controlling and regulating the financial markets. And one of the biggest changes was the introduction of the FSR, or Financial Sector Regulation Act of 2017. The main aim of this act is to promote and enhance the integrity of the financial sector, protect its users and customers, and promote and maintain financial stability, but also to encourage market confidence in the financial system, meaning to contribute to the protection and enhancement of stability of the financial system and securing the appropriate degree of protection for consumers. The Act also established the Prudential Authority as well as the FSCA, or Financial Sector Conduct Authority. Remember, this was known as the FSB before. And what it did was give both these entities the power to preserve and enhance financial stability. But they had to do this working together with the South African Reserve Bank Oversight Committee, who was to ensure both the regulation and supervision of financial services providers. So this establishment of this approach is known as the Twin Peaks model. Now let's get to know these role players a little bit better and how they fit into the greater scheme of things. First up is the FSCA, or Financial Sector Conduct Authority. When it was originally established, it was established through legislation to oversee non-banking financial services industry. For example, your retirement funds, short-term and long-term insurance companies, funeral insurance schemes, collective investment schemes like unit trusts and the stock market, and the financial advisors and brokers. Remember, it used to be called the FSB, and through the establishment of the Twin Peaks approach, it then became the Financial Sector Conduct Authority, even though so many of us still refer to it as the FSB. The FSCA aims to enhance the efficiency and integrity of financial markets, promote fair customer treatment by financial institutions, provide financial education and promote financial literacy, as well as assist in maintaining financial stability in the sector. Well, those are very flowery words which are fantastic, but how does this actually work in practice? Well, in promoting efficiency and integrity of the financial markets, the FSCA focuses on ensuring that market participants act honestly and fairly, providing easier access to financial products and services, and promoting fair customer treatment. The FSCA concerns itself with the conduct of all financial services providers within the financial services environment. The FSCA achieved these objectives by setting and enforcing rules governing transparency of the market information, rules to avoid market abuse, and requirements to oversee financial markets and market infrastructure. Now let's move on to the PA, or the Prudential Authority. Under the Twin Peaks approach, or Twin Peaks model, the Prudential Authority, which is actually a subdivision of the South African Reserve Bank, now takes on the role of prudential regulator for both banking and non-banking financial institutions. The main aim of the PA is to promote the safety and soundness of financial institutions and market structures across the financial services sector, and to protect customers against the risk that financial institutions may fail with their obligations towards financial services consumers. You and I, basically. Now, if you have a bond or you have a loan or anything like that, as a South African, you know about the South African Reserve Bank, because they are the ones that decide what the interest rates are going to be, right? So most of us South Africans know exactly what the South African Reserve Bank is. It's our central bank, and its primary function is to protect the value of the rand, or the South African currency. In doing so, they take responsibility for a few things, like ensuring that South African money, a banking system, and financial system as a whole is sound, it makes sense, and it runs well, that it meets the requirements of us as South Africans, and that it keeps pace with international developments. They also assist the South African government as well as other members of the Southern African Economic Community, SADC, with data or information that is relevant for them to formulate and implement macroeconomic policies. They also have a job to inform us as South Africans as well as stakeholders abroad about monetary policy here and the South African economic situation. The next role player we look at is the National Credit Regulator, or the NCR. The National Credit Regulator was established through the National Credit Act, or the NCA, Act number 34 of 2005. And they are responsible for the regulation of the South African credit industry. So where there's a loan of some sort, the NCR is involved. The objectives then of the NCR, amongst others, include promoting a fair and non-discriminatory marketplace to consumer credit. So all people must be treated with fairness, providing the general regulation of consumer credit and improved standards of consumer information, promoting black economic empowerment and ownership within the consumer credit industry. Remember that black people were traditionally excluded from certain parts of the economy outside of simply being consumers. Prohibiting certain unfair credit and credit marketing practices. So, in terms of unfair credit, you must remember that there's a point where people, because of the color of their skin, were being charged extra interest rates by a certain number of banks. Or also credit marketing practices, how we put the product in front of the consumer is also important. They're also responsible for promoting responsible credit granting and prohibiting reckless credit granting. Right? There was a point before the NCA where banks, if you remember how African Bank ended up actually going under before it was rescued recently, it was because of reckless lending practices where they gave credit to people that could not possibly afford to pay it back or had very bad credit records and shouldn't have been able to access credit at that time. Another of their responsibilities is providing for debt reorganizing in cases of debt of over indebtedness, providing for the registration of credit bureaus, credit providers, and debt counseling services. Under the new Twin Peaks approach or Twin Peaks model, the NCR will continue to regulate consumer credit but will work cooperatively alongside the new Prudential Authority and the Market Conduct Authority as well. Another key role player in this sector is the Council for Medical Schemes, or the CMS. And this council is an autonomous statutory, meaning legal body, created by Parliament to regulate medical schemes in South Africa. It was established through the Medical Schemes Act number 131 of 1998, and the reason was for it to provide regulatory supervision of private health financing through medical schemes. Governance of the council is vested in a board appointed by the Minister of Health, consisting of a non-executive chairperson, deputy chairperson, and 13 members. The executive head of the council is the registrar, also appointed by the minister in terms of the Medical Schemes Act. The council determines overall policy, but day-to-day decisions and management of staff are the responsibility of the registrar and the executive managers. The council supervises a massive and particularly important industry comprising more than 70 medical schemes registered in the country. So you can imagine just how many lives depend on these medical schemes running well. Under the new Twin Peaks approach, the Council for Medical Schemes will continue to regulate the medical schemes. Next is the Umbad Council, and if you've had a dispute with your dealership or a bank or your insurer or anything else, you may have heard that you have the option to approach the Umbad. Now, the Umbad Council was established through the Financial Sector Regulatory Act FSR of 2017, and the gist of it is that they help us have better access to affordable, effective, independent, and fair alternative dispute resolution when we have complaints about financial institutions. This includes complaints that relate to financial products, financial services, and services provided by market infrastructure such as exchanges. The Umbad Council itself does not manage independent or individual customer complaints, right? It oversees all financial sector Umbad schemes. in essence is operating as the regulatory authority for Umbat. So if you've had that problem with your dealership, you may have approached the motor industry ombudsman. That ombudsman is overseen by this council. The Umbud Council will assist complainants with identifying which Umbud is responsible for hearing their complaint in cases where the jurisdiction is unclear. So where we might not know who exactly is the party you should be complaining to, the Umbud Council will give you guidance. So in doing so, the Umbud Council will promote accessibility and use of the Umbud system, cooperation and coordination amongst Umbuds, effectiveness of the Umbud system, including through imposing common standards of good practice amongst all Umbuds. Now, this next role player, the Financial Intelligence Center, is arguably one of the most important, if not the most important element in our financial system. They basically the intelligence unit, like a CIA of sorts for our financial sector. And they concern themselves with anti-money laundering, countering financing of terrorism, as well as proliferation. And in doing so, they must receive regulatory reports and transactions and other data from accountable institutions and other businesses. So for example, banks are accountable institutions and must report if there are suspicious transactions. They must then interpret this information and analyze the data that they have received. Once they have done so, they must produce financial intelligence from this data for the use of competent authorities in their investigations, prosecutions, and applications for asset forfeiture. So let's look at a real life example. Let's say, for example, I'm a drug dealer and decide to take the proceeds of my criminal empire to buy myself a Lamborghini. The dealership, as an accountable institution, must then report this suspicious transaction to the Financial Intelligence Center. Once they have interpreted and analyzed the data, they must produce a financial intelligence report that they must give to the relevant authorities. So this would then go to the police. Once the police have built up their case, they will pass it to the National Prosecuting Authority, who will then apply to the courts for an asset forfeiture order. And so it begins. They must also produce forensic evidence based on the flow of financial transactions and obviously exchange information with bodies that have similar objectives in other countries regarding the combating of money laundering, the financing of terrorism, and also proliferation and other similar activities. On top of that, they must facilitate effective supervision and enforcement by supervisory bodies. Now remember, the center was given rise to by the Financial Intelligence Center Act, which is Act number 38 of 2001. And it allows the center the ability to identify proceeds of crime, to combat money laundering, to combat the financing of terrorism, as well as the financing of the proliferation of WMDs or weapons of mass destruction. The Act was amended in 2017 to provide for a risk-based approach to customer due diligence. Also, the supervisory powers and information sharing requirements of the financial intelligence sector have been improved together with its administrative and enforcement mechanism. So all in all, a better act giving them broader, more precise powers in terms of prosecuting the things that they need to be looking out for. Further amendments were introduced in 2022, and these were to Schedules 1, 2, and 3. And the idea here was to address the scope of coverage weaknesses identified in the 2009 and 2019 FATF mutual evaluations of South Africa. The amendments were brought into operation in 19 December 2022. But what changes did these amendments actually bring about on the ground? Well, it broadened or increased the sectoral coverage of the Act, meaning that new accountable institutions were added to the mix. So industries, professions, and professionals that previously did not have to account to the center suddenly had to. And this brought about enhancements in terms of anti-money laundering, enhancements in terms of countering the financing of terrorism and countering the financing of proliferation of weapons of mass destruction. It also brought about changes to compliance supervision for accountable institutions, both old and new. The center oversees and enforces FICA compliance among non-financial businesses and professions listed in Schedule 1 of the Act, including the gambling sector, estate agents, legal practitioners, as well as high-value goods dealers. Credit providers sectors and crypto asset services providers also fall within the FIC's supervisory function. Collectively, these sectors and professions are called the designated non-financial businesses and professions, or DNFBPs. There were also amendments made to the MLTFC regulations, or the Money Laundering and Terrorist Financing Control regulations. The threshold and other aspects relating to reporting cash transactions contained in the regulations were amended effective 24 November 2022. The new prescribed threshold amount of 49,999 Rand 99 cents was introduced, meaning all cash transactions 50,000 Rand and above must now be reported. Before then, any transaction 25,000 Rand and above had to be reported. So let's make this a little bit simpler. So say I am buying a vehicle and choose to put in a deposit of 25,000 Rand. Under the previous rules, what would have to happen is that they would have to report that within 2 business days. However, with the new rules where the amount is 50,000 Rand and above, they only have to report that within 3 days. So the reporting of cash threshold aggregation was removed, and the period within which cash threshold transactions are to be reported was extended from 2 to 3 business days from the date on which a transaction exceeding the prescribed limit has taken place. But those were not the only amendments to the regulations. Section 31 and Section 56 on the reporting of cross-border electronic funds transactions above the prescribed threshold of 19,999 Rand 99 cents also came into effect on the 1st of February 2023. It introduces in Section 31 a new reporting stream, the International Funds Transfers Report. And the IFTRs requires accountable institutions that are authorized to conduct transactions to transfer funds electronically in and out of South Africa to report prescribed information in respect to cross-border electronic funds transactions above the prescribed threshold of 19,999. While Section 56 makes it a criminal offense to not report international electronic funds transfers that exceed this threshold. It's important that we bear in mind that FICA, and indeed the Financial Intelligence Center, is not something that works in isolation. FICA works together with the Prevention of Organized Crime Act, POCA, the Prevention and Combating of Corrupt Activities Act, PRECA, and the Protection of Constitutional Democracy Against Terrorism and Related Activities Act, or POCDATARA. POCA focuses on criminalization of money laundering, combating organized crime, and the prohibition of activities related to racketeering and money laundering. POCDATARA focuses on the criminalization of terrorist financing activities and the freezing of assets that may be used to support the execution of terrorist activities. Now, PRECA, I can see you rolling your eyes already, is actually a crucial piece of legislation in South Africa's fight against corruption. Now, here are role players that most of us understand. The banks. What is their role and what is their purpose? Let me put it to you in unnecessarily complicated terms. Banks are important to the economy of the country because they function as brokers or intermediaries through which the funds of a surplus unit, people who save money actually have it in cash, can be made available to shortage units, people like me who have no money and need to borrow to survive. And this is done in order to finance productive investment activities. This is absolutely vital to the functioning of an economy. Banks also provide an entire range of financial services and advice to the public, such as payment services that are an everyday fact and without which the economy cannot function at all. This schematic gives you an idea of just some of the everyday transactions that you and I both know we do all the time, like depositing money into banks, taking loans out from banks, repaying those loans, getting interest, paying interest, etc. Let's do a deeper dive into these institutions that we trust with basically our lives and all of our money. Let's look at the legal structure of banks. All banks, firstly, must be registered as public companies and must also be registered by the Registrar of Banks in terms of the Banks Act number 94 of 1990 before they can start doing any business whatsoever. And to get a banking license, they need to meet very strict requirements. Now, Section 13, subsection 2 of the Banks Act stipulates that the registrar will determine, amongst other things, whether the establishment of the proposed bank will be in the public interest, whether the business the applicant proposes to conduct is that of a bank actually. The applicant will conduct the proposed business of a bank in the capacity of a public company incorporated and registered under the Companies Act, and that the applicant will be able to establish itself successfully as a bank. The registrar will also have to determine whether the applicant will have the financial means to comply in their capacity as a bank with the requirements of the Act, that the business of the proposed bank will be conducted in a prudent manner, that every person who is to be a director or an executive officer of the proposed bank is, in as far as can be reasonably ascertained, a fit and proper person to hold the office of such director or executive officer. Also, that every person who is to be an executive officer of the proposed bank has sufficient experience of the management of the kind of business it is intended to conduct, and the composition of the board of directors of the proposed bank will be appropriate with regard to the nature and scale of the business it is intending to conduct. Now that we've talked about the legal structure, let's talk about the product range. And by product range, I don't really want to talk about the normal stuff that you are used to. I want to talk about things that may be considered short-term insurance. And short-term insurance typically covers risks for a limited period, usually 1 year or less. So among banks' products, the following are considered to be short-term insurance, like credit life. Or say, for example, you have a loan with Capitec Bank, and within the period of your loan, say it's a 12-month loan, you are retrenched from work. If all the conditions of your credit life policy are met, the insurer should pay for your debt for at least 6 months. Remember, it's a short-term version of the credit life insurance, which covers outstanding loan balances in case of death, disability, or retrenchment. Retrenchment is just one of those examples. There's also vehicle insurance, which covers damage or loss of a vehicle for a short term, usually renewable every single year. You also have homeowners insurance for a short-term or short-term property insurance, which covers damage to the property or belongings due to a fire, theft, or even natural causes. So you can even think, if you are someone who lives on land that is dolomatic, meaning it is subject to sinking every now and then, causing damage to your house, your homeowners insurance might be able to cover that. There's personal accident insurance as well, which provides financial protection against accidental injuries or death, typically with annual renewal as well. Then you have travel insurance, which covers medical insurance. In fact, some countries you cannot go to without producing proof of medical cover, because they don't want you to come there and be a burden on their hospitals. You can also cover lost luggage or trip cancellations for a specific travel period. And there's hospital cashback plans. These, you know, if you've ever seen Desmond on TV saying, "Should you die?" This pays out a fixed daily amount during hospitalization, usually an amount that is paid from I think the third day that you have been in hospital, it will pay you a certain amount every single day that either escalates or de-escalates as time goes by. But banks can offer products outside of short-term insurance and normal banking. They can offer life insurance, they can offer retirement annuities and endowment policies as well. Before we move on to short-term insurers, long-term insurers, and medical aids and such, I'd like to speak about the JSE Limited, formerly known as the Johannesburg Stock Exchange. The JSE is licensed as an exchange under the Financial Markets Act of 2012 and is the biggest or the best in Africa. A stock exchange is simply a marketplace where traders buy and sell stocks. It's that simple. It has been in operation for the last 120 years. Currently, the JSE has evolved from a traditional floor-based equities trading market where people would wave around papers and shout across the floor to a more modern securities exchange providing fully electronic trading, clearing and settlement in equities, financial and agricultural derivatives and other associated instruments, and has extensive surveillance capabilities. The JSE is also a major provider of financial information as well. So while we are not going to spend too much time on the JSE, we are going to have a quick look at its legal structure. Like I said, it is licensed to operate under the Financial Markets Act number 19 of 2012. It is the frontline regulator for the exchange, setting and enforcing listing and membership requirements and trading rules. Currently, the FSCA supervises the JSE in the performance of its regulatory duties. As already mentioned, the regulatory landscape is set to change significantly in the future as South Africa looks to implement a Twin Peaks model of oversight. So now let's talk about long-term insurers. What is their role and what is their purpose? A lot of us know long-term insurers as life insurers, and they also called this in the New Insurance Act number 18 of 2017. And their main purpose is to provide people like you and me with appropriate products that assist us in achieving the financial goals that we want in life. Note that long-term insurers can assist individuals like you and me or groups of clients, meaning companies that want to provide benefits to their employees. Therefore, they have a major duty to take care of our money, since millions of us rely on them to invest and grow our hard-earned cash, whether we want that money to be able to send our children to university, to go on a dream holiday, or to be able to retire comfortably one day with a house on the beach. We rely on long-term insurers to be able to pay out a lump sum or a monthly benefit once we are affected by an adverse life event such as unexpected death, disability, or severe illness. So for example, if I have a life policy with disability in it, I am hoping that should I have an accident that causes my disability, they will give me a lump sum so I can make alterations to my house to make it wheelchair friendly, maybe get a vehicle that is disability friendly. And then on a monthly basis, because I can no longer earn an income, I expect that my policy will be giving me money so that I can survive, pay my bills, pay my electricity, and have groceries in my fridge. But now that we know the why of long-term insurers, what is the legal structure that gives them effect? Well, because of their significant role as custodians of people's money, long-term insurers currently need to be licensed by both the FSCA and the Prudential Authority in terms of the Insurance Act number 18 of 2017 before they can commence business. So they need a license from the PA, which is under the South African Reserve Bank, as well as the FSCA, which was formerly known as the Financial Services Board. To obtain the license, they need to meet the following very strict requirements. And the first is that the primary business activity must be the conducting of insurance business. Must also meet certain requirements with regard to its key individuals or key persons and significant owners, business plans, transformation of the insurance sector, operational management capabilities, and so on. The licensing must not be contrary to the interest of prospective policyholders or the public interest. So policies must be built in such a way that they are for the good of the public and also for the good of the policyholders. If such an insurance company is state-owned, it needs to be authorized by an act of parliament to conduct such insurance business. Let's dive a little bit deeper. The license issued by the PA or Prudential Authority may impose licensing conditions necessary to achieve the objectives of the Insurance Act. Once the license to operate has been granted by the PA, the insurer must ensure that a reference to the fact that such a license is held is contained in its business documentation and marketing material. So everything that they beam out to the public must say that they are licensed by the PA. These businesses must also continue to meet appropriate conditions, for example, having an appropriate governance framework. The PA, remember, deals with the prudent conducting of business. So the PA has the right to prescribe governance principles and requirements relating to items listed in the Act and may, under certain circumstances, revoke or withdraw a license issued under the Insurance Act when such company no longer meets the requirements. So what kind of products do long-term insurers have? Well, a typical product range for a long-term insurer could consist of the following: risk cover products such as whole life cover, term cover, accidental cover, funeral cover, disability, temporary disability, and functional impairment cover, and severe illness. And these products are also known as life risk policies. Then you may also have savings products such as endowment policies, sinking fund policies, and retirement annuities. You also have income provision products such as compulsory guaranteed annuities, living annuities, and voluntary annuities. Now, short-term insurers, these are known as non-life insurers in terms of the new Insurance Act number 18 of 2017, and their main purpose is to provide a range of products that assist us in protecting our physical assets such as our houses, our furniture, our phones, our cars from unexpected loss, probably theft or damage. And what they do is they provide a lump sum to repair or replace these very expensive assets when the loss or damage occurs. In addition to this, clients can also protect themselves against unexpected legal claims against them, such as a claim for damages caused to a third party, you drive into somebody else's car, etc. So short-term insurers are much more straightforward than what we saw with long-term insurers. But what is the legal structure that makes them possible? As in the case of long-term insurers, short-term insurers currently also need to be licensed with the Prudential Authority in terms of Act number 18, the Insurance Act of 2017. That's before they can even commence business. Now, in order to align with the Twin Peaks regulatory approach, the Insurance Act number 18 of 2017, which became effective only the 1st of July 2018, replaces the prudential framework requirements of the current long and short-term insurance acts, while market conduct will be in future centralized in the Conduct of Financial Institutions Bill, or COFI. Now, to obtain a license, they need to meet similar stringent requirements as in the case of long-term insurers as well, and similar licensing conditions necessary to achieve the objectives of the Insurance Act may be imposed. So again, just like with long-term insurers, short-term insurers, once their license to operate has been granted by the PA, must make reference to the fact that such license is held in anything that is in their business documentation and marketing material. So they must beam out to the public that they are licensed through the Prudential Authority. Now, hearing this a second time, you're probably asking yourself why. And the simple reason is that if we know that their license has been granted through the PA, then we know how to hold them accountable should they do something that is not in line with the requirements of said license and the public good. These businesses must also continue to meet appropriate conditions, for example, having an appropriate governance structure. The PA still has the right to prescribe governance principles and requirements related to items listed in the Act, that being the Short-Term Insurance Act number 18 of 2017, and may under certain circumstances revoke or withdraw a license issued under the Insurance Act. And as we've done with other role players so far, what are the typical product ranges or products that you can find from a short-term, again, non-life insurer? Typical range for short-term insurers would include, amongst other things, motor vehicle insurance, homeowners insurance, householders insurance or household insurance, all risk insurance. Now this provides covers for loss against or damage to personal items, like when you lose your laptop or cell phone or your handbag, etc. Stuff that you generally carry with you when you're going up and down in your normal life. And obviously there's also personal liability insurance, which provides cover for when you are in the wrong and have caused a third party some loss or damage. Next on our list of role players is medical schemes. What is their role and what is their purpose? A medical scheme is established to provide medical financing aid to cover a large group of individuals. These individuals can be from the same employer group, or they could be a large group of private individuals. For example, you can join Discovery because you work for Ford Motors in South Africa and that's who they use for their medical aid. Or you could, as a private individual, phone Discovery and join them as a member. Members pay monthly contributions to a medical aid fund, and when any of the members have medical expenses, the costs are paid from this fund. All registered medical schemes have to comply with the provisions of the Medical Schemes Act number 131 of 1998. So now let's look at the legal structure of medical schemes. The first and most important is that before they can commence any sort of business, they need to be registered with the Registrar of Medical Schemes as well as the Council of Medical Schemes. And this is in terms, obviously, of the Medical Schemes Act number 131 of 1998. Now, what licensing requirements do they need to meet? Now, first of all, members of the Board of Trustees as well as the Principal Officer for the proposed medical scheme must be fit and proper to hold the offices concerned. The medical scheme is or will be financially sound, and the medical scheme has sufficient number of members who contribute or are likely to contribute to the medical scheme. The medical scheme does not or will not unfairly discriminate directly or indirectly against any person on one or more arbitrary grounds, including race, age, gender, marital status, ethnicity or social origin, sexual orientation, pregnancy, disability, and state of health, etc. So constitutional rights basically, and the registration of the medical scheme is not contrary to the public good. Now, the registrar may also demand from the person who manages the business of the medical scheme, which is in the process of being established, financial guarantees to ensure the financial stability of the medical aid. So reserves or promises of reserves or whatever the case may be. Somebody has to stand in surety in case there is catastrophic or high claims. They'll be able to do what they need to do. Now, take note, there are currently plans in place by the South African government to implement the National Health Insurance. And I'm sure you've seen debates about this for years now. Now, this is likely to lead to extensive restructuring of the public and private healthcare sector, including medical schemes, over the next couple of years. So let's move on to the next role player in the market. And those are employee retirement benefit suppliers. What is their role and what is their purpose? Well, the answer to both of those questions is really in what you call them. The main purposes of providers of retirement fund benefits is to provide a range of products that assist clients, mainly corporate clients such as business enterprises, to in turn assist their employees in saving money towards their retirement. Retirement products such as pension funds and provident funds are intended as vehicles to provide for an income at the retirement stage, and as such have favorable tax benefits to encourage saving. Why the favorable tax benefit? Well, because if you have your own pension, the state doesn't have to pay one for you. So in turn, the state gives you a tax benefit. Just like with the other role players, let's take a quick look at the legal structure of employee retirement benefit suppliers. These suppliers consist of suppliers who offer a range of retirement fund structures and retirement solutions to bigger and smaller companies. Bigger companies may opt to have their own registered pension funds, while smaller companies would use the employee retirement benefit supplier's umbrella fund. Each pension or provident fund is registered as an individual retirement fund by the Registrar of Pension Funds, and as such is governed by the Pension Funds Act number 24 of 1956 as amended from time to time. The Commissioner for Inland Revenue also approves these funds so that contributions and benefits are taxed in accordance with the Income Tax Act to enable the special tax concessions that apply to retirement benefit products. There are initial and then ongoing requirements for actuarial soundness that apply to anyone registering a retirement fund before a license to operate can be issued. In addition, the Pension Funds Act requires each fund to appoint a board of at least 4 members who will have the duty to act as trustees on behalf of the registered retirement fund, and to ensure that decisions made by the fund are in the best interest of its members, the employees who belong to that fund. Another requirement is that each retirement fund must have a set of rules which set out, amongst others, how the fund will be managed and administered, and how decisions about the fund will be made by the trustees. Now, what kind of products can you expect from these sort of suppliers? Well, you can expect group risk insurance benefits such as group life cover, funeral cover, group occupational disability, and temporary disability cover as well. Pension fund benefits provide registered pension funds for companies. Provident fund benefits provide registered provident funds for companies. And then preservation funds benefits provide registered preservation pension and preservation provident funds for employees who leave a registered pension or provident fund due to resignation from employment. Umbrella funds provide access for companies to join an already registered pension or provident fund. Pretty straightforward. I know you're tired, but right now we've arrived at the last of the role players that we'll be looking at for the financial services industry. In this unit so far, we have discussed the main role players in the financial services industry that supply the market with products. Among these are banks, long-term and short-term insurers, as well as employee retirement benefits, and obviously various regulators and acts that deal with this section. Other products such as collective investments and the underlying asset classes are covered in more detail in a class of business module that is investments. By now you've figured out that we'll obviously look at the role and purpose of financial services providers. We also have to discuss some of the typical products that they offer. Although these products are very important to ensure a person's financial well-being in the present as well as in the future, many people in South Africa are poorly educated about the importance of financial planning or are fearful about financial products due to their intangible nature and due to the complexity of some of these products. If I could give you a gold bar that you could purchase from me by giving you your money, it would be much easier for you to swallow than me saying I am taking your money and investing it in gold, because that gold bar you can touch, and that is where poor financial education comes into play. For this reason, the industry also requires competent professionals who can provide clients with the necessary information and advice needed to achieve financial planning objectives, and in order to assist the client to make the right decisions on the most appropriate product for their specific needs. This obviously requires that you give somebody a reasonable amount of information for them to make an informed decision. To execute this, we have to look at financial services providers as groups of qualified professionals who link up the clients who need financial services with the product suppliers. So these will be the intermediaries between the actual supplier and the client. Their role includes contacting and reaching clients done through call centers or by direct face-to-face contact or at branches, educating and guiding clients on financial planning needs, providing clients with information about financial products and services, and advising clients in terms of appropriate products and services for their specific needs. Think a financial needs analysis and where you go to from there. The Financial Advisory and Intermediary Services Act, known as FASE, regulates this provision of financial services by FSPs. Financial services include providing advice and or intermediary services about financial products, distributing those products, marketing and selling, dealing in product administration, and providing support services such as record keeping and administration. Now, in terms of the Act, and by Act here I mean FASE, people who provide either advice or an intermediary services and work for an authorized FSP are known as representatives and are defined in the FASE Act as any person who renders a financial services for or on behalf of a financial services provider in terms of conditions of employment or any other mandatory agreement, but excludes a person rendering clerical, technical, administrative, legal, or accounting services, which service does not require judgment on the part of that person or does not lead a client to any specific transaction in respect of a financial product in response to general inquiry. So the people who are excluded from being called representatives are people who may work for an FSP but in IT, and that person does not render any sort of advice or services in terms of a product, or they could be part of the legal team, or they could be part of admin. Those people do not necessarily qualify as representatives and therefore do not have to meet the conditions set out in the Financial Advisory and Intermediary Services Act. So before Act number 32 of 2002, the FASE Act came into being, anyone could be employed or mandated directly by a product supplier or role player to distribute products based mainly on their ability to sell. So if you are a good salesman, we could literally drag you off the street today and you could be selling a product tomorrow. Currently, however, financial services providers are required to apply to the FSCA for a license in terms of the FASE Act before they may operate as financial services providers. This license sets out the different product categories or classes of business in respect of which the financial services provider may provide financial services. So you would have to be qualified in certain things in order for you to sell those things, and you would have product categories that you are able to sell according to what you qualify for and what you have experience in. Now, myself, for example, I needed to get an IIP, which is an initial insurance program credit of 32 credits on NQF level 4 to be able to sell short-term insurance. In terms of general insurance, I have a wealth management certificate which allows me to sell long-term insurance as well as medical schemes, investments, etc. If you take my ID number or my full names and give it to the FSCA, they will show you the exact product categories that I am allowed to sell as an individual representative and which companies I have been able to sell them under. You'll also notice that those companies have certain categories or classes of business that they too are allowed to sell, And this is what we are talking about in terms of the FSCA granting licenses and conditions based on classes of business. Now, if you've been in the financial services sector for any amount of time, you've probably heard key individuals a lot. And if you're new, well, you're going to hear it a lot. The Act requires key individuals who are the managing staff who oversee the provision of financial services to clients in an FSP or financial services provider to meet certain fit and proper requirements. Fit and proper requirements is something that you're going to hear a lot of as well. Representatives who are the professionals providing the financial services to the clients are required to meet similar fit and proper requirements as those applicable to key individuals. The financial services providers then are required to keep updated registers of all the representatives authorized to act on behalf of them. Any representative who loses their fit and proper status needs to be removed from the register and prohibited from acting on behalf of that financial services provider. So what products can be distributed by FSPs? Well, they have to apply for licenses in all the distinct categories and subcategories, or rather classes of products that they intend to give advice on or distribute. Any representative who acts on their behalf can only provide financial services in those categories that the company they are working for has obtained licenses in. For example, in the case of an FSP that provides financial services in respect of assistance policies such as funeral policies, that FSP would be licensed as a Category 1 provider in long-term insurance subcategory A, as would an FSP that sells short-term personal lines policies such as comprehensive or homeowners insurance. So there is at times an overlap between certain categories that can be sold and how you attain licenses there too. For now, this seems like a lot of information, but remember, we are not going into detail into each of the role players, not in this unit. So for now, let's do a quick summary to make sure that we distill our knowledge on the overview of the industry so that we have a solid base from which to go forward with our class of business. Over these last few slides, we're going to go slightly slower to make sure that we distill the information we've gone through properly, because this information serves as the foundation on which your class of business studies will hinge. So without further ado, let's get into the fact that the financial services sector has moved towards a streamlined Twin Peaks regulatory approach, enhancing the sector's ability to strengthen South Africa's approach to consumer protection and market conduct in financial services. This is also a way of creating a more resilient and stable financial system, and the sector contains various market participants that will be described below. The main regulatory role players include the FSCA, whose job it is to regulate market conduct for the sector. The PA, or Prudential Authority, remember they are a division or a subdivision of the South African Reserve Bank, and they act as the prudential regulator for the financial services sector. Then you have the NCR, or the National Credit Regulator, which regulates the South African credit industry. The Council for Medical Schemes regulates medical schemes, and the Ombud Council oversees the different ombuds in the financial services industry. Next in our summary are the banks. They provide a range of financial services such as day-to-day payment services and loan services, which also mobilizes savings and other short-term funds for long-term investments and growth purposes in the South African economy. Typical products of a bank include transactional accounts, savings accounts, investments accounts, credit cards, loans, and asset finance. Then of course we have the JSE, or the Johannesburg Stock Exchange, which provides a marketplace for buyers and sellers to trade equities, bonds, options, and futures and other securities. And then, of course, we have long-term insurers. They pay out lump sums and/or regular income payments to affected life insureds or families in case of adverse life events such as unexpected death, disability, and severe illness. These lump sums or income payments are used to ease the financial burden or cost associated with and to replace income or earnings lost as a result of the adverse life events. So long-term insurers also provide opportunities for long-term savings, meaning that these savings can in turn be used to invest in the economy of the country. Typical products of long-term insurers include risk products such as life cover, disability cover, and severe illness cover, also known as dread disease, depending on which company you're talking to. Savings and investment products such as endowments and retirement annuities, and income provision products such as voluntary or compulsory annuities. We also took a look at short-term insurers, and a lot of us will be more familiar with short-term insurance than we are with long-term insurers, because while both of these are grudge purchases, long-term insurance feels a lot more to people like it's optional, and it really isn't. It's something that we should all have. But we are more familiar with short-term insurance because either we know somebody or we've bought a car through the bank, and the bank insists that if they're going to finance your car, it must always have short-term insurance. So the job of short-term insurance is to provide protection for physical assets such as homes, furniture, motor vehicles from unexpected loss or damage by providing lump sums to repair or replace these assets if loss or damage occurs. Short-term insurers also provide protection against unexpected legal claims such as a claim for damages caused to a third party. This is when you've taken your eyes off the road for a second and you drive into somebody else's car. Typical products of short-term insurers include motor vehicle insurance, homeowners insurance, household contents, all risk. Remember, all risk is stuff that you carry with you typically every single day. It might be your firearm, it might be your phone, it might be your laptop, etc. And obviously personal liability insurance. Then, of course, we took a look at medical schemes, and their job is to provide medical financial aid to large groups of individuals. And members pay monthly contributions to a medical aid fund, and when any of the members have medical emergencies or expenses, the costs are paid from the general medical fund. Then before we looked at FSPs, we looked at employee retirement benefit suppliers. And their job is to provide a range of products that assist clients, mainly corporate clients such as business enterprises, to in turn assist their employees in saving money towards their retirement so that they can obtain an income in the form of a monthly annuity or a pension once they reach retirement age. Typical employee retirement benefit products include retirement benefit products such as pension and provident funds, preservation funds, and umbrella funds, and group risk insurance benefits such as group life cover, group funeral cover, and group disability cover. Finally, we looked at FSPs, or financial services providers, and hopefully this is still fresh in your mind, but if it's not, here's a quick summary. Their job is to provide the service to the consumer where through a network of representative clients are contacted and products are distributed to them on behalf of the role players we've discussed, while also providing financial planning. Typical products that they may be distributed depend on the category or subcategories for which the FSP has a license. And just like that, we've come to the end of this video. I hope you've enjoyed it. I hope you've learned a lot. Please do not hesitate to contact us on 065-062-5930. Please note that this number does function for my other business, so be specific in what you need to say, or email me on tiromakuru@gmail.com. Unambiguous Training Solutions, feels it's an absolute privilege to contribute in some way to your future. Thank you very much. We'll catch you in the next video.